Welcome everybody. How you doing out there? Glad you could join us for our little live stream today. So we're going to be talking about some of the research that we've conducted recently on the smart building startup landscape. So a little bit of housekeeping to start off with. We are obviously recording this session, so if you do want to share it with your colleagues, then you'll find the recording up on YouTube. Or obviously we're also streaming on YouTube as well. So you can go there. Recording will be up straight away after we finished. Whilst you're on YouTube, please subscribe to the channel. We post all of the live streams and podcast episodes that we do there, and also clips from the podcasts and stuff that we do. So there's that. Then there's also questions. You know, we love to make these kind of sessions interactive. And this is kind of an interesting topic, and I think people will have some opinions. So questions, opinions, you want to disagree, agree, put it in the comments, and I'll read it out and we can talk about it later. And I'm basically going to start by showing some slides, discussing some of the findings from our research, and we'll take it from there. If you're just joining us, welcome. And we're talking about the smart building startup landscape today. So let's have a quick look at some of the topics we're going to cover. First of all, we're just going to give you sort of like an idea of like the scope of our research, right? So what do I mean when I say smart building startups, landscape and technology? So we kind of break that down and show you like how we categorize companies and like what kind of technology we're talking about, and also how we define a startup. Then we're going to talk about some of the numbers that we've tracked, like around how much money's been invested that we've seen, both through venture capital and private equity. Then give you some thoughts of mine on the market in general, what we're seeing in terms of disruption in the market, in terms of technology. Then sort of to follow on that, like reasons why market disruption is difficult. And then finally, I wouldn't call it advice, but maybe some kind of like findings of ours on, how we've seen startups, start gaining some traction in the market, and some thoughts about like what, from our experience over the last 10 years of what we've seen there, just a couple of points. So yeah, again, if you're just joining us, welcome. This is what we're talking about today. If you have questions, just type them in and I'll get to them. I can't see them at the moment, but I'll get to them later and we can cover them in the Q&A portion. So this is a chart from the landscape report that we published a couple of weeks ago. And it sort of defines how we think about the landscape in terms of technology, right? And obviously, I think it's obviously important to define what we mean by smart building landscape. So over the course of the research that we've done for years now, we've identified over 1,200 startups that are active in the management and operations phase of commercial real estate. So that's what we're covering, management and operation phase, not Contech, not sort of like the whole leasing or administration of a building like that. So that's what we define as the smart building landscape. The startup portion of it, we basically define a startup as a private company that is less than 10 years old. That's sort of roughly what it is. Probably have received some investment and are active in that portion of the market, and generally will fit in one of these buckets that you can see. So we split this into 4 different areas. First one being IoT technology, and the Internet of Things as a concept. Now we've been living it for a while, and I think it really does pervade quite a lot of technology areas in smart buildings. It's a driver for many of the startups we've identified, and our category here accounts for the in terms of number of startups, about 19% of the total. And we define an IoT platform as basically software or hardware that facilitates a range of applications. They could be from performance benchmarking, equipment optimization, occupancy analytics, for example. Second one, we term as building energy management. That as a category encompasses energy and climate tech, as well as grid interactive buildings. So for example, demand response, virtual power plant technology, distributed energy resources, and energy storage solutions. And that counts for about 26% of the total. Clearly a very popular category, the most popular. Prop tech is a category, again, this is a broad category, we've used it, I'm sure others kind of their interpretation or their definition of prop tech is different. In this instance, we're using it to encompass a range of software and hardware solutions and services for building management. So that would include asset and maintenance management, workplace management, location and mapping, indoor air quality, drones, robotics, those kind of things. And finally, physical security. So that's video surveillance and analytics, access control, biometrics, and things like incident management. And that accounts for about 14% of the startups that we've tracked. So that's what we're talking about here today. So in terms of numbers, since 2015, we've tracked about 37 billion invested in these type of companies. That includes 17.3 billion invested just in the last 3 years. By that I mean 21, 22, and 23. 21 was actually, a high watermark for investment. We tracked 7.6 billion at that point, and it has reduced since then. But there is a healthy amount of funding that's going into companies looking at how to improve the operation and efficiency of commercial buildings. Just in the first 4 months of 2024, we've seen 2 billion invested. Of all of the companies we've tracked since 2015, we have seen about 35% of startups being acquired. So, disruption of operation and maintenance technology. I don't want to talk about market disruption for the sake of it. I mean, it's not the purpose of technology, right? The purpose of technology is in the context anyway of operating and maintaining commercial building, is to improve the efficiency and improve outcomes for the owner of that building or whatever it is that they want to achieve. If the supply chain is also disrupted, then that can have a good impact on the industry as a whole. And I think it is fairly standard industry thinking now that we know the way that technology in commercial buildings is procured, delivered, and commissioned is suboptimal and could be improved. So I think an element of a, maybe not disruption, but at least improvement in the supply chain is very much needed. I mean, should we expect even startup companies to create disruption? It's hard to achieve success, let alone some kind of, big, catalyzing a big event that really shifts the market. Even well-funded startups that are backed by some of the top venture capital companies have a relatively small percentage chance of success. And of course, it really depends how you define success. Success for some companies will be different from others. Success can be, an exit, an acquisition. And I think in that context, actually, whilst that's a success to the particular company, can we consider that to be something that is of good for the wider industry? For example, like an exit to a corporate buyer might be achieved at a very good exit valuation. But what does that mean then going forward for the industry? I think like that capital probably gets returned to the VC, could be reinvested in other startups. That's great. Hopefully spurs more innovation. But it also could reinforce the kind of industry status quo to some extent, and maybe makes disruption less likely. So, not looking at the technology, but looking at some of the other reasons why the lack of or why there is a lack of disruption in the supply chain. And you could pick various number of topics, right? There isn't particularly just one, but I'm just going to talk about 4. And you can see it in this chart here. Tech life cycles versus building life cycles. The life cycle of a system in a building and the building itself can be measured in decades, whereas software life cycles are measured in months. Software needs to be patched and updated more regularly, whereas systems might not need to be replaced or refurbished for 10 or more years in some cases. And even in some cases may not even be commissioned correctly in the first place. So this leads to, I think, like a disconnect. People often talk about the disconnect between IT and OT in building technology, and that's one of the reasons why. Second one, complicated and suboptimal technology delivery. So again, kind of alluded to it, a well-known issue on, for example, new construction projects. There are various subcontracts that come down from the main contractor, and those contracts will be to install and commission various technology systems. So the company responsible for installing one system like lighting will probably not be the company that's also responsible for installing and commissioning the BMS, for example. And it's in this aspect, it's often a low margin business, right? So these companies are not incentivized to just deliver on the best technology. They're trying to make a profit, and they could often engineer out some functionality if that's the difference between having some margin and no margin. None of this, I think, is particularly conducive to delivering the best technology for a client. And we've talked a lot about this previously. You can go back and look at some of the articles we've written over the last few years. Third one, aligning incentives. So again, there can often be competing incentives within the supply chain. So if you take like a commercial real estate investor, one that might own a portfolio of buildings, they're going to be focused on NOI, net operating income, which is the profitability of those income generating real estate investments. So it's the revenue from the property minus the operating or the necessary operating expenses. So additional operating expenses, which let's say building technology, right, may not be prioritized as they're seen as an operating expense. I think good news here is that the attitude towards some technology is changing. Of course, we're seeing tighter energy regulations and sustainability reporting in the EU, in the US, and that is obviously going to make investors think about their asset, right? And they're going to want it will need to reach energy code. Final one, stakeholder influence. So I say, for a startup entering the market, it may not always be obvious to them who the actual sort of customer will be, the one who's going to write the check, who the stakeholder is, and what their incentives are. So I think that's something that startups need to spend a lot of time understanding, especially because sales cycles for systems and software and technology can be really long. And if you're expecting people to put their hand in their pocket for upfront capital expense, then it's going to take a while. So I've just put up here 3 things which I think we would say are reasonable advice for a startup company who's looking to gain traction in the market. And like a lot of innovation that comes from companies, you're not going to fail because of probably the value of the technology. You may have something that is going to be really useful to optimize the building, but it might be that it's more about the business model or finding the appropriate route to market. You really goes back to the last point. You really need to try and satisfy all of the decision makers in the chain, right? You need to identify your customer and be laser focused on solving their particular problems. Second one, around distribution strategy. I think developing key partnerships for distribution can really speed up sales in this industry. So leveraging those partners' existing customers or installed base can make a big difference. And I'd say actually furthermore, it's not really like the number of partnerships. It's the depth of those partnerships and how they can be used to gain traction in the market. And finally, flexibility. So, people say it quite a lot, commercial buildings are snowflakes. A lot of them are different. They can vary in age. They can materials that's been used to make them, location, what technology, if it's a retrofit project, what's already in there, what existing technology is there. Can be very different. And across a portfolio, again, buildings can vary wildly. So what works to optimize one building might not work particularly well for another. So having some flexibility within your solution and in your go-to-market strategy that accounts for variation, I think can be really useful and really help you gain traction quicker. So this is a report I was talking about. We published this just a couple of weeks ago, and we actually look at some of the companies that we think of gaining traction in the market and covering some of the subjects that I've just covered here. Also, just wanted to remind you guys, we offer a subscription to all of our content. So, we're producing in-depth reports as well as notes on the website. So you can sign up for a premium subscription, and that comes with a AI chatbot that we've developed called AIM, and that leverages the power of large language models onto our data set. So we have a large data set around the smart building technology market, and you can use a large language model to query that data set, ask it questions in natural language, and get back results, just like you would with ChatGPT. But here we have access to all of our data. So you can email us if you want to hear more about that. And be really happy to hear what you guys think, whether you agree, whether you disagree, any advice for startups, any thoughts on market disruption, where the market's going. Would be really interesting to hear people's comments. Let's see if there are any. See if I can pull it up here. Here we are. Okay, a few people joining here saying greetings from Nottingham, greetings from Amsterdam. Great, yep. And it's sunny here as well in Stockholm. So, yeah, get outside and enjoy the weather after this. Let's have a look. Is there anything on YouTube? Okay. Well, let us know if there's any comments. I mean, while we're waiting, I mean, we can, I think, going back to the landscape kind of research that we did, I mean, would be interesting, I think, to compare, how the sort of operation and maintenance phase, which is our focus on different areas of prop tech, Contech, for example. We haven't done that, and I think that would be an interesting analysis. And we've got a couple of questions come in here. I'll just take them as they come. Given the slow uptake of novel tech in this space, what do you think your presentation will tell us in 5 years? I don't want to be pessimistic, actually. I think that we are seeing some interesting technology, and we're seeing some interesting applications of that technology, and we are seeing startup companies gaining traction. I think what we're not seeing yet is companies that, let's say, reach the perhaps 50 million turnover to take that step to 100, half a billion revenue, to really kind of take a significant market share and try to disrupt. Whether that happens in 5 years, given what I've talked about around some of the barriers to disruption, not really sure. But I do think there's plenty of opportunities for startups to achieve a good exit, and I think we'll continue to see that. Again, as I showed you some of the numbers, we're not seeing particularly slowdown in investment, and in the same way, we're not seeing a massive slowdown in acquisitions either. Thanks for the question. Other question: what's your view on startups and globalization? How fast do the successful ones go global beyond their home territory? Yeah, kind of. I think covered that in the last question. But like in terms of geographic success, yeah, I think there's clearly some difference in geography. We just wrote an article on a company here in Europe, and clearly they're gaining some traction in their home market. How that translates to they're growing, they're trying to grow into Europe, and how that works, how they could grow into North America, those are some sort of unanswered questions. They're going to encounter different things in those markets that maybe weren't a barrier to them before, could be a barrier. There's a lot of legacy issues that go with commercial real estate and building technology, and different regulations and standards in different markets. So yeah, I think it's a challenge. Another question: what's the average money raised of those successful startup stories? What's the average of years to be successful? Just trying to think if we looked at the average deal value. I can't think of it off. I don't think we actually put that in the research, but I can double check. I mean, definitely the size of Series A rounds has increased, and seed rounds. So very not uncommon now to see Series A rounds of above 10 million, 15 million, and so how that impacts the average, not entirely sure, but yeah, average years of success. I mean, that's really interesting. There was an article, we tried to do some comparison looking at average time to, of companies within other technology sectors average, time to 1 billion. And it's come down a lot. Like, for example, OpenAI, for example. But, it really depends how you define success, right? Success to some companies in this sector might just be an acquisition. And then, we've seen companies acquired that are 4, 5, 6 years old. Could be, so it really depends. Okay, got 3 more questions. I'll try and get these 3 done before we stop, because we've got about 4 minutes. Do you foresee the higher interest rates increasing or decreasing exit acquisitions? I'm not an economic expert, but I believe, right, we're going to probably see interest rates come down, right? That's sort of what people are saying. How that impacts exits, acquisitions, I'm not sure. I can just tell you what we've seen so far this year. 2 billion invested in the first 4 months, which is an increase on the year before. So I think 2014 will see an increase in investment. How it affects acquisitions, we'll see. Again, I expect value of acquisitions to actually be up this year. Emmanuel, hi, how you doing? Hope you're well. James, the disruption will come from non-conventional startups, those creating an ecosystem to benefit from AI. Interesting point. Yeah. How successful have startups been in monetizing building data? Yeah, I don't know if that's like maybe a rhetoric question, because I think at the moment they haven't been particularly successful in monetizing building data. And if they can, then that will definitely could definitely see some disruption there. And definitely got time for the last question. What category of startups are getting the funding? I don't know. Can we go back to the slide I showed before, Dan? Let me just put it up. Hang on. That one. So, as I've said, this is kind of like showing the total. Now, to be on this list, you don't have to have had some investment, but basically everyone has. And those are the categories that we have made. So you can see here the ones that are most popular. I think the top one there being workplace management, occupancy analytics, followed by asset maintenance management, video analytics, super popular, energy management software, as you would expect, also super popular. So those are the ones that have achieved the most funding, the most number of rounds probably. All right. Okay, I don't know if there's any more questions. Okay, I think that's probably it. Thanks everyone for listening, and really appreciate you taking the time. If you want to share it with colleagues, then please do. I think you can just share it on LinkedIn, or as I said, go on YouTube as well. If you search for Smart Building Series on YouTube, you'll find us. And hope to see you again. We're going to take a break for summer, but we'll be back in September with some more content for you guys. See you then.